What they never told you about the market. Have you ever wondered why the market always seems to move against you right before it goes where you predicted? You spot a perfect setup. You've done your analysis. You've drawn your lines, checked your indicators. Everything aligns. And yet, the market hits your stop loss, reverses, and runs exactly in the direction you expected. What if I told you, it's not your fault? What if I told you that 90% of traders lose not because they're wrong, but because they're being played inside invisible zones of power, zones built by institutional money, hidden in plain sight? These zones are called supply and demand. And if you can read them, truly read them, you stop trading like the herd, and start trading with the people who move the market. This isn't about guessing candles or chasing indicators. This is about understanding who's behind every move you see, and why they do it. Welcome to the real map of the market. What supply and demand really mean. Let's strip away the noise. Forget the indicators, forget the fancy names. At its core, every move in the market comes down to one thing: an imbalance between buyers and sellers. When there's more buying interest than selling, price rises. When there's more selling pressure than buying, price falls. But here's what most traders miss: these imbalances don't happen randomly. They form in zones, small areas on the chart where big institutions quietly accumulate or distribute orders. A demand zone forms where big players have placed large buy orders. A supply zone forms where they've placed large sell orders. Price doesn't move because of magic. It moves because those orders, those massive blocks of money, create energy. And once that energy is released, it drives price away from that zone like a spring snapping back. You're not trading candles. You're trading the footprints of capital. Once you see this truth, you'll never look at a chart the same way again. How to identify a real zone. Now comes the question: how do you find real zones, not just random rectangles traders draw everywhere? There are only a few rules, but they separate the pros from the crowd. The base: every valid supply or demand zone begins with a base. That's the area where price paused before making a strong impulsive move, either up or down. Think of it as a coiled spring, storing potential energy. The move away, the stronger and cleaner the move away, the more powerful the zone. If price explodes out with long candles, leaving almost no wicks, that's not retail traders, that's institutions executing massive orders. The number of candles: this is crucial. A valid zone typically forms within 6 candles or less. More than 6. It's invalidated. Why? Because it means price stayed there too long, too much equilibrium, too many orders filled. The spring has lost its tension. Simple rule: fewer candles equals fresher energy. The more price rests in a zone, the weaker it becomes. The power of time frame alignment. Here's where most traders fail. They find a clean supply or demand zone on a 15-minute chart. But they forget to look at the bigger picture. Every small zone exists inside a larger story, the structure of higher time frames. If your 15M demand zone aligns with a 4H or daily demand zone, your probability skyrockets. If it doesn't align, you're fighting against the tide. Think of the market like an ocean. The higher time frames are the currents. The lower time frames are just waves. You can surf the waves, but if you surf against the current, no matter how skilled you are, you'll drown. So before you enter any trade, ask yourself, does this zone align with the dominant structure of higher time frames? If not, walk away. Discipline is the difference between intuition and impulse. How to spot ranging markets. Now, let's talk about one of the most overlooked stages of the market, the range. This is where the market moves sideways, neither breaking highs nor lows. It's a trap, but also a signal. Here's the key: When price fails to break a high twice and fails to break a low twice, you're likely in a range. Neither buyers nor sellers are in control, equilibrium dominates. Think of it like a battlefield after a long fight, both sides exhausted, no one advancing. Volume decreases, liquidity builds. The big players are loading up. They use the range to accumulate or distribute orders, preparing for the next major move. So instead of chasing fake breakouts, mark your range boundaries. When price finally breaks with conviction, that's your map to where the next liquidity pool lies. Learn to love the range, it's where the next opportunity is born. The manipulation, how they hunts liquidity. You've probably seen it, price approaches a beautiful demand zone. You're ready, waiting for the pump. But before reversing, the market pushes a little lower, just enough to stop you out, then collapses exactly as predicted. That's not coincidence. That's liquidity engineering. Institutions know where retail traders place their stop losses. They've studied the same textbooks, watched the same tutorials, memorized the same patterns. So they use that knowledge against you. They drive price slightly beyond the zone to harvest liquidity, your stops, before unleashing the true move. It's not manipulation in the emotional sense. It's simply business. You're not losing because you're bad. You're losing because you're visible. Real power in trading comes from being invisible, from understanding how the game is played beneath the surface. When is a zone still valid? Not every zone remains valid forever. Markets evolve. Orders get filled. Conditions change. So, how do you know when a zone has lost its edge? Here are the golden rules. 1. Multiple touches equals weakness. The more times price taps a zone, the less likely it is to hold again. Each touch absorbs orders, until there's nothing left. The first touch? Highest probability. The second? Still decent. The third? It's a ticking bomb. 2. Strong departure equals fresh intent. After price leaves a zone, does it move with strength, long-bodied candles, no hesitation? That's confirmation the zone had real institutional backing. 3. Return speed. If price returns too quickly to the zone, be cautious. Fast retests often mean the zone didn't have enough imbalance to sustain movement. Remember, the market doesn't owe you repetition. Freshness equals opportunity. Stale zones equal traps. How to refine zones. You've probably seen traders draw massive boxes covering half the chart. That's not precision, that's noise. To refine your zone, move to a lower time frame, from 4H to 15M, for example. Identify the exact candle where the impulsive move began, that's often the candle with a wick rejection or engulfing body. That candle, and the wick beneath or above it, is your true institutional footprint. Now, combine this with timeframe alignment. If your refined 15M demand zone sits inside a 4H demand zone, you've just found a confluence point, the sweet spot where probability meets precision. That's how pros enter the market, not by guessing, but by reading the rhythm of time itself. The psychology of zone failure. Every trader remembers that one loss that made them question everything. You followed every rule. You waited for confirmation. And yet, it failed. What happens next isn't about the chart. It's about you. You begin to doubt your system. You redraw zones, force new entries, chase revenge trades. But the truth is simple, even the best zones fail. Even institutions get stopped out. The difference is that professionals accept probability, while amateurs crave certainty. And that craving, that emotional need for perfection, destroys more accounts than bad analysis ever will. Detach from the outcome. You're not here to win every trade. You're here to read the story of money, and align with it when it makes sense. Once you internalize that, you'll stop fearing losses, and start mastering patience. The trap and release sequence. Picture this: price is inside a range. You've marked your supply and demand perfectly. You're waiting for the breakout. Then suddenly, it breaks the range to the upside. You think, this is it. You buy. And seconds later, it reverses violently, slicing through your position like it was nothing. Congratulations, you just experienced the trap and release. Institutions push price above the range to trigger buy stops, sucking in retail liquidity. This is liquidity pools hunting manipulations. They dump their own sell orders into that newly created buying pressure. The market reverses. Retail traders panic. Institution profits. This is how markets truly move, not by logic, but by liquidity behavior. Your job is to think like the hunter, not the prey. The next time you see a breakout, don't react. Wait. Let them show their hand. Then act. Because patience is the new aggression. We have so many examples of manipulations in the channel. You can't find our system anywhere. I expose the truth of trading in the world. I am the truth. Multi-timeframe alignment, how professionals build confluence. Retail traders live on one chart. Professionals live across dimensions of time. A strong demand zone on the 4-hour chart might contain a refined 15-minute area. That's where precision meets power. So here's the formula: top-down scan, start from the daily. Identify the macro direction. Are we overall bullish or bearish? 4-hour confirmation, locate key supply or demand zones that align with that macro bias. 15-minute execution, drill down. Find the refined candle to enter with precision. Each timeframe is a lens. The higher ones show intention. The lower ones show execution. When you learn to move through time frames like this, your confidence shifts. You stop being reactive. You start feeling one step ahead, almost predictive. That feeling? That's what professional calm looks like. The emotional spiral, how traders destroy perfect setups. Let's talk about what happens inside your mind when your zone fails. You see price touch your demand zone. It reacts perfectly, a few pips in profit. Then it reverses. You freeze. You move your stop loss just a little lower. You justify it, it's just a deeper retest. Seconds later, stop hit. Then price rockets in your original direction. You stare at the screen in disbelief. You replay the moment again and again, thinking, what if I just waited? That's the loop. That's the mental trap that keeps 95% of traders stuck. The market didn't beat you. Your emotions did. The key is not to avoid pain, but to understand it. Every failed setup reveals a pattern inside you. The charts don't lie, they mirror your impatience. The moment you stop chasing perfection and start studying your emotional reactions, you evolve from a trader into a strategist. The anatomy of a professional trade plan. Every great trader has a plan, not a prediction. A plan means you already know where you'll enter, where you'll be wrong, and what you'll do next. Here's how to build a professional trade using supply and demand logic. Mark your zone, identify a valid, fresh zone on a higher time frame. Wait for liquidity grab, let price sweep the obvious highs or lows near your zone. Drop to lower time frame, refine your entry candle, the moment displacement begins. Play stop beyond structure, behind the zone that created the move, not randomly. Target the opposite liquidity pool, price always moves from one imbalance to another. That's how pros do it, one clean trade, backed by logic and discipline. They don't chase the market. They let the market come to them. Every click of buy or sell should feel boring. If it feels exciting, you're gambling. If it feels calm, you're trading. Why supply and demand isn't about boxes on a chart. Let's pause. Forget the rectangles, the terms, the patterns. What is supply and demand really about? It's about human behavior under pressure. Every candle represents thousands of emotional decisions: fear, greed, panic, hope. Supply forms when euphoria peaks, when everyone's buying, and institutions quietly sell into that enthusiasm. Demand forms when despair dominates, when everyone's selling, and institutions accumulate silently. So you're not trading zones. You're trading emotion at scale. That's why mastering psychology isn't optional, it's the foundation. Every chart pattern, every zone, every imbalance is just an echo of human weakness. The day you start reading the chart like a map of emotion, not numbers, is the day your results change forever. Valid versus invalid zones, the hidden math behind reactions. A valid supply or demand zone is not a guess. It's measurable. It has rules. Here's how professionals separate illusion from truth: origin of impulse. The zone must cause a clear displacement, a large move that breaks structure, not a lazy drift. Candle count. Ask yourself, is more than 6 candles inside the base? It's probably invalid. Too much noise, too many late entries. Freshness, has price touched the zone before? If yes, the orders are likely consumed. The fresher the zone, the stronger the reaction. An invalid zone tempts your impatience. It looks close enough. But close enough is the vocabulary of retail emotion. Precision is the language of professionals. When you stop asking, will it react? And start asking, does it deserve to? Your trading IQ jumps by a decade. Liquidity and supply/demand fusion. This is where real mastery begins, combining liquidity, supply and demand, into one fluent language. Imagine this sequence: equal highs form above a supply zone. A spike sweeps those highs, liquidity taken. Price taps the supply zone, rejects, displaces. The imbalance forms, you enter on mitigation. That's the market maker's blueprint: liquidity fuels, supply triggers, imbalance confirms. Your old self wanted one indicator to save you. Your evolved self understands, it's the storyline that matters. Each concept plays a character in the script. If you can tell the story of price, you no longer need to predict the ending, you just follow the plot. Trade management, mastering the middle. Entries are easy. Exits are art. Between entry and exit lies the battlefield called management. Here's the structure used by professionals: partial profit, remove 50% at the first opposing liquidity level. Trail smartly, move stop behind new structure, not candle by candle. Let the rest run, allow the higher timeframe story to finish. This is where fear disguises itself as logic. You'll justify closing early, protecting capital. But often, it's just avoidance of emotional discomfort. If you can't sit through drawdown, you can't sit through growth. Discipline isn't holding a trade, it's holding your nerve. Invalidation, the power of being wrong fast. Every professional is fluent in loss. Because loss is the tuition you pay for clarity. An invalidated zone isn't a failure, it's information. Rules of graceful invalidation: respect your stop. Never move it out of hope. Mark the invalid zone, label consumed supply or invalid demand. Observe where price goes next, it reveals the next valid area. Your ego screams, I can't be wrong twice. But the market doesn't care. The faster you admit defeat, the sooner you recover control. The slow loser dies by denial. The fast loser wins by adaptation. You're not here to win every trade. You're here to understand every move. That's what turns a chart reader into a market architect. The psychological trap of overmarking. Too many traders clutter their charts with boxes, every little pause becomes a zone. That's chaos. You must train your eyes to filter noise. Ask yourself, was there clear displacement after the base? Did volume surge? Was liquidity taken before the move? If not, it's not a zone. It's a distraction. Clean charts reflect clean thinking. How institutions build traps around zones. Here's a secret: institutions know you see those zones. They engineered them. So what do? They tap the zone partially to trigger your early entry. Push slightly beyond to sweep stop losses. Reverse violently, leaving you emotionally wrecked. That's why you never enter blindly. Wait for confirmation. Risk management inside zones. Your stop loss should sit beyond the structure, not inside it. If it's inside, you're bait. Position size is the lifeline. Use the rule: risk 1%, aim for 3-5R. Don't over-leverage just because the setup looks perfect. Perfection doesn't exist. Probability does. How to read candle behavior in zones. When price enters a zone, observe: slow compression equals liquidity building. Sudden wick rejection equals smart money activating. Engulfing candle plus volume spike equals confirmation. That's when you pull the trigger. You're not guessing. You're reacting to intent. Common mistakes that kill trades. Entering before confirmation. Ignoring time of day behavior. Using zones from illiquid sessions. Forgetting to check higher time frame bias. Remember, a beautiful setup on the wrong side of the trend is still a losing trade. The emotional cycle of supply and demand traders. Every trader experiences it: excitement, fear, hope, revenge. Supply and demand doesn't just test your chart skills, it tests your psychology. When you miss a perfect setup, stay calm. Another one always forms. When you take a loss, analyze it, don't personalize it. Trading is not a battle against the market, it's a battle against yourself. The hidden architecture of every move. Here's the truth most never realize: every rally, every drop, every fakeout, begins with imbalance, structured by institutions, anchored in supply and demand. The market isn't random. It's designed. You can either be on the inside of that design, or remain part of the liquidity pool that fuels it. So next time you open a chart, don't look for entries. Look for stories: where the fear began, where the greed peaked, and where equilibrium will return. Because that's all the market is: a constant shift between excess and balance. And as you learn to see that rhythm, the chaos quiets, your confidence grows, and you start trading like the architect, not the prey. Stay focused, stay disciplined. And in the next video, we'll reveal more.